Hello, I'm Jessie. This is Jessie G, and we're going to talk about mortgages today. Okay, I am a licensed loan officer, I'm a licensed realtor, and today this is educational and informational purposes only. Okay, we're just breaking it down. We're just talking about the different loan programs, and we're going to talk further about the loan programs that are available in Smith County in a different video. Understand that each applicant has qualifications they must meet. This is not financial advice, and make sure you do your own research. First-time home buyer. What does it mean to be a first-time home buyer? It means you don't have any interest in any property in the last 3 years. You don't have a mortgage, you don't have a note, you don't have a deed, you don't have anything in the last 3 years. There is an exception to this for people who may have had ownership in the last 3 years, but let's say they got divorced and now they're going to purchase a property on their own. We're also going to set the rules here and say, I'm talking about your primary residence, meaning you're going to live in it full time. I'm talking about a single unit, so not a duplex or a triplex. I'm talking about traditional income qualifications, meaning you have 2 years of tax returns, have a 2-year credit history, tell us where you've been for the last 2 years, rent-wise, and that's kind of the rules on this one. There we go. You know, I would normally do this with like a PowerPoint presentation or something, but you know, we're winging it over here, okay? The 4 traditional loan options programs are VA, USDA, FHA, and conventional. VA loans are for our veterans only. The beauty of this program is they can get up to 100% financing. They have no mortgage insurance, but they do have a funding fee. And that funding fee is 2.15%. Now, they get a certificate of eligibility, which will detail more information about the loan and if they're going to pay that funding fee. And that funding fee, it can either be paid up front or it can be rolled into the loan amount. So that's the VA loan. USDA. This is another option for 100% financing. But the USDA loans are rural loans. Actually enter the property address into their website to determine if they're in a coverage area, and then there's also income caps for a USDA loan. Now, USDA loans do not have private mortgage insurance, but there is a mortgage insurance, and there's something called a guaranteed fee. That guaranteed fee is about 1%. Our next option is FHA, a very popular loan program for first-time home buyers. This is because the LTV is 96.5% on a FHA loan, meaning they need a 3.5% down. There's mortgage insurance called a mortgage insurance premium. It is monthly and it will stay on this loan until the last payment is made for the life of the loan. There's also an upfront mortgage insurance premium, which is about 1.75% of the loan amount. That too can be rolled into your loan amount or you can be paid up front. So that's something to consider as it's part of your closing costs on an FHA loan. Other program for first-time home buyers is conventional. When you hear the names Fannie Mae and Freddie Mac, those are conventional loans, and they offer 97% to first-time home buyers. They have monthly mortgage, and it's called PMI, private mortgage insurance. Private mortgage insurance until you reach 80% of the value. So it eventually falls off, but it is a cost associated with this loan. So these are traditional finance options. Non-QM financing is what you're probably going to find for mortgage brokers or retail offices. Self-employed borrowers or 1099 borrowers, perhaps on their tax returns they have a lot of write-off and they're not able to qualify in the traditional sense. You can actually use 12 months personal bank statements or 12 months business bank statements and get something called a bank statement loan. TV on a bank statement loan is not 100%. It's not even 95%. It's probably 90, if not 80%. It has a reserve requirement, meaning you got to have some money in the bank for this particular loan. Jumbo loans. Let's talk about jumbo loans. So a jumbo loan is basically a loan amount that exceeds, let's just keep it simple and say $800K. And yes, first-time homebuyers can buy a multi-million-dollar property. It happens all the time. TV on something like that is about 80%, and it's probably up to about $3 million. The other thing is that you're going to have secondary appraisals, you're going to have reserve requirements. It's a little bit stricter, just like a bank statement loan. ITIN is for our non-permanent resident friends. And so yes, they too can purchase a property. You're not going to get 100% financing. You're probably going to get about 80% financing, but it's an option and I think you should know about it. Asset utilization. This would be a loan program that is very non-traditional. I've seen options for like using Bitcoin assets to qualify. Is different. You're going to need higher FICO scores for something like this. You're going to see about an 80% LTV, if not lower. But for the right buyer, it's an option. And yes, you could be a first-time home buyer and utilize something like an asset utilization. Basics of the different loan options. There's more in there. Let me tell you, this is very high overview. I encourage you, work with your loan officer, work with your realtor, and utilize the financing that will help you get into the home. Next video, I'm going to talk about what if you make about $65,000 a year or less and you live in Smith County? What options are available to you? Because there's a really great program and I want to give you that information, but I felt like we needed to set the foundation first so you understand why we're going to focus in on a couple aspects like mortgage insurance and LTV. That's going to be what we're talking about in my next video. I really thank you for your time and I hope you have a great day. I'll see you in the next one.